In this video, I will tell you how market maker models can tell you everything you need to know. You might ask yourself, do I go long? Do I go short? What value gap should I use? And I used to ask myself the same question before finding out about market maker models. And now I'm a full-time trader with over $1 million in funding. In this video, I will show you the 3 secrets on making money with market maker models. No time to waste, let's get into it. When talking about market maker models, you first need to understand the 2 actions of price. It's very simple. Price can only trade to external range liquidity or internal range liquidity. External range liquidity is grabbing liquidity, old highs and old lows. Rebalancing, this internal range liquidity, is rebalancing or to equilibrium. That means if you have a swing high and a swing low, if you mark out that range, the 50% of that range is called equilibrium, the 50% of the range, and it can also seek fair value gaps. So it can or go to equilibrium or it can go to a fair value gap. And all your trades must have one of these 2 ideas in it. And to build further on this, your highest probability trades are the ones with the higher time frame order flow. When you're bullish, you want to long. When you're higher time frame bearish, you want to short. And the key for the market maker models is to find a market maker buy model when you are bullish and a market maker sell model when you are bearish. So this is what I want my higher time frame, my daily, weekly or monthly to look like. So we are in trending conditions. Trending consolidations is by default lower probability. So I want price to trend on the higher time frame. So you want price to go from internal back to external, to the recent high. Then it displays again, leaving another fair value gap. That's internal range liquidity. Comes back to internal to external to external. And all these areas is where I want to find a market maker buy model to trade in. And how does a market maker buy model look like? Market maker buy model looks exactly like this. So it starts at the original consolidation. Textbook, it looks like this, but it can also look a little messier with a little more like this. It doesn't need to be the exact schematic, but ideally you want low resistance low. That means swing highs that did not take out any liquidity. Low resistance high to be at the top of the original consolidation. And then you have in the market maker buy model the sell side of the curve. And the sell side of the curve leaves behind low resistance liquidity. If you're not sure what low resistance liquidity is, I have a dedicated video to liquidity on this YouTube channel. It's basically leaving out a swing high that doesn't take out any other liquidity. So we're not doing this to go lower. No, we have a failure swing. We don't break this high before going lower. Same here. And you want that sell side of the curve to trade lower into a key level on the higher time frame. So in the previous example on the chart, we saw a daily fair value gap. It can be an old low, can be an old bullish fair value gap, a busy or a bullish order block bullish breaker. In this example, let's pretend this is a daily fair value gap. And inside the daily fair value gap is where you want to see something called a smart money reversal. It's a V-shaped recovery, aggressive sells, aggressive buys. And ideally, you also want an SMT with this. So in that higher time frame key level, there is where you wait for price to give an energetic reaction, displacement, ideally leaving a fair value gap. There needs to be a market structure shift. A market structure shift is created when the last swing high that made the low is broken. So once we close over here, we have a market structure shift. Once we leave a fair value gap here, this is where your low risk buy is. So here you can take a buy, stop loss below the low for like a 1 to 2 for an easy trade. If you miss this one, you want price to trade up again. And ideally, this leaves another fair value gap. This is a stage of accumulation. This is called the stage of a distribution, and the buy side of the curve is called accumulation because we're accumulating orders to the upside, going for that buy side liquidity, the liquidity that was left behind in this original consolidation. But once we trade lower and lower, all these highs have become small buy side liquidity pools. So every time we want to trade higher, we want to target these buy side liquidity pools. So from the low risk buy, if you miss it, you want to take a second trade into the newly created fair value gap because we have a down close candle to trade into a fair value gap. This down close candle is probably also an order block. So in this area, you have an order block and a fair value gap defending your position. And you still have that higher time frame drawn liquidity, the buy side liquidity on top, and this short-term buy side liquidity pools as well. And in most market maker models, you even have a third option, and that is when there's the final reaccumulation, the final move per value gap, and that pushes towards the drawn liquidity. That's going to be the original consolidation. And where on the sell side of the curve, we need to have low resistance liquidity being created, so failure swings. On the buy side of the curve, we want discount arrays to hold our position, to defend our position to the upside in our market maker buy model. So here we have fair value gaps, order blocks. We can maybe have bullish breakers, mitigation blocks, all that stuff, all the PD arrays you learn in ICT concepts. They need to be defending your position to the upside, to the buy side liquidity. And as an intraday trader, when you are from the daily level, you can take a trade here, you can take a trade here, you can take a trade here. In a higher time frame, market maker model, you can take multiple trades as a day trader. If you're a swing trader, it can be less, maybe 1 or 2. But as a day trader, you can play around with this. And I want to dive deeper with you on what's happening down here. What do you want to see for the smart money reversal? You want to see an SMT and a market structure shift. We already covered the market structure shift. That is the last swing high that made the low. If that is violated, that is where your market structure shift occurs. But what is an SMT and how does that look like? An SMT is a crack in correlation. So you have correlated pairs. For the indices, for example, that is NASDAQ and ES and YM, the US indices. For the USD pairs, for example, Euro US dollar and GP US dollar, two correlated pairs. You can have gold and silver. You can have Bitcoin and Ethereum, all correlated pairs. And correlated pairs means they need to move the same. So if Euro US dollar goes up, GP US dollar goes up. If NASDAQ goes down, ES goes down. But an SMT is when there's a crack in correlation. They stop following each other all of a sudden. So for example, we are approaching an old low or an old discount array, higher time and key level. And in that, we have, for example, NASDAQ making a lower low, but ES or GU does not make that. So between the two correlated pairs, there's now a crack in correlation because they stop following each other. And an SMT is an indication that we might going to reverse. So we're going down, we might reverse to the upside. So if you combine this SMT with the market structure shift, there's where you have a very powerful tool on your hands. And this is why the smart money reversal is so powerful. And bonus points here, because here, for example, NASDAQ makes a lower low and ES doesn't make a lower low, means ES is stronger because it was too strong to take that low out. So if you want to take a longs, try to long the pair that made the bullish SMT here. Vice versa for bearish, if you're at the top, you want to short the pair that does not make the higher high because that's one of the weaker one. So in this example, if NASDAQ makes a lower low, ES doesn't make a lower low, you see that ES is more bullish, so you want to long ES. And now we know that what a market maker model is. Here you see a market maker model. But in this example, what we did is from a daily level, trying to frame a market maker buy model. And in that higher type of market maker buy model, all these areas, all the blue shaded areas, the areas of accumulation, you can find lower time frame mini market maker models inside that piece of price action. So every time price goes from internal to external, that is your market maker model. Internal to external, market maker buy model. Internal to external. So in a higher time frame market maker model, you can find tiny market maker models on the lower time frame. So here is where time frame alignment comes in. You hear that price is fractal. So what happens on the daily or the weekly or monthly also happens on the 1 minute, 5 minute and the 15 minute. So let's dive deeper into how that works. And that's called time frame alignment. So if, for example, have a monthly level, a monthly fair value gap, you want to have a daily market maker model. So weekly fair value gap, you want a 4-hour market maker model. From the daily, we go to the 1 hour. And this is more swing trader territory because here are your executions on the daily 4-hour and the 1 hour. For day traders, you can look at 4-hour levels, 1-hour levels and 50-minute levels. And this is even scalper territory where you just go from a 50-minute bullish fair value gap for a 1 minute market maker buy model. But keep in mind, no matter what time frame you trade on, no matter what time frame you look for your levels, wait for that SMT and smart money reversal. That's your confidence that confirms you probably are going from sell side to buy side. And of course, I don't want to waste your time. Everything is vice versa for a market maker sell model, where you wait for an SMT at the top and then go lower to the original consolidation. And now you know what a market maker model is, how you can use the time frames to align with your higher time frame levels and to find lower time frame market maker models inside higher time frame market maker models. Now let's see how that actually works on the charts. I spent hundreds of hours studying ICT concepts and I broke down every single concept with my own personal notes in this 500-page PDF. It goes over everything from entry models to the different concepts, from interest rates to everything you need. So if you want to save those hundreds of hours, want to get it right now, I will leave the link to this PDF in the description. So here we're looking at gold on the daily time frame. And what I'm now going to show you works on gold and silver. It works on the indices like NASDAQ, or it works on Forex. It's a universal model. It works on all the asset classes. And what we want to see is trending conditions on the higher time frame. Well, you guys can see this is a trending condition on the higher time frame. It's been trending for a while. So we want to look for bullish internal to external market maker buy models from daily levels here. You can do the same on a weekly or a monthly. For example, we're sticking on the daily. And using time frame alignment, when you have a daily level, you go to a 1 hour market maker model. So let's look at this example right here on this fair value gap and see from the 1 hour if we can frame a entry around this. So now we are zoomed in on a 1 hour time frame, and here is where we tap that daily fair value gap. And what you see after that happens is we have aggressive sells, aggressive buys with a fair value gap. So in this fair value gap is your low risk buy. So from here, you can take your entry in the fair value gap, and not only a fair value gap, we also have an order block sitting right here, a 1 hour order block. So we have a fair value gap and order block in this area. So here you can wait for the entry. Your drawn liquidity is from internal to external. So external liquidity is the recent high. So that's right here. So your TP is going to be up here for a static 1 to 2. And this would have been your entry. If you missed this one, there was another fair value gap before we going higher again. Cool. So now you saw it on this example. Let's look at this example, because here we tap into the fair value gap multiple times. So again, from a daily level, let's drop to the 1 hour to see what's happening in this area. So let's make this area blue again. Let's go. And then we drop to the 1 hour time frame to see how we could have framed entries around this. So here we look at the 1 hour time frame. So here's the first tap into the daily fair value gap, but after that we have the second tap into the fair value gap. But let's look at the first tap at the start, because this is where you already want to get in, right? This is your internal to external. So internal liquidity is tapped here during the New York kill zone at 8, and our external liquidity is right here. So here's where you want to find a market maker model. Well, what I see here is failure swings. All these swing highs do not take out any liquidity. So you're creating a staircase lower and lower, lower. Aggressive sells, aggressive buys. We even take out some short-term liquidity right here, making this a high resistance low. And then we break structure. Last swing high that made the low, creating a fair value gap, and also an order block. Similar situation. From internal to external on a daily, we drop to the 1 hour to find our entry. So here as well, internal fair value gap, TP at the high for a static 1 to 2. So in this case, your stop loss will be not below the low, but below the fair value gap, and the order block will get tapped in before making a move. Cool. Well, we have seen in hindsight that we are going into the fair value gap one more time. We take out this low. So once this happens, right here, it looks like, oh no, we are going into a sell model. And of course, you see here a market maker sell model. Why? Because we have failure swings down here. We sweep liquidity before breaking structure. There's not too many clear fair value gaps. I would say this would have been the fair value gap point of interest. And from this point, we just displace lower. But keep in mind, this is a market maker sell model in bullish conditions. You want high probability trades. That means you want to long when you are bullish on the daily. Remember, we are in a very bullish trending conditions. So when I see this, I'm expecting this to be a turtle soup. And that means a liquidity sweep from a swing low here. So I am still bullish until we start making fair value gaps to the downside, bearish fair value gaps. Until that happens, I'm still bullish. So that means when we go back to the 1 hour, here is where I would like to see displacement happening again to the upside, creating fair value gaps. Let's see if we do that. So here in this example, we have another 1 hour liquidity sweep, and we start a market maker buy model. And this is not too clean, right? Because here you see not that aggressive sells, aggressive buys, it's not so clean as the first one. So, okay, you could have said, okay, I'm going for this small fair value gap right here, and I take my entry from here during the London session here. But what if you anticipate this to happen, but it's not too clear on the 1 hour? Remember that a 1 hour market maker buy model, you can also drop even lower from the 1 hour to the 5 minutes. So let's drop to the 5 minutes and see if we can find entry somewhere here. It's during the New York session. And what do we see here? Close the New York lunch. We have aggressive sells, aggressive buys with fair value gaps. And we start creating on a 5 minute time frame. We start creating structure to the upside. And that is what you want to see. And also here in the London session, displacement higher, taking out all the failure swings here. See how much liquidity is created? It's all failure swings. So from this point, aggressive sells, aggressive buys. There is no fair value gap here for entry. So in this price, I wouldn't have my entry from the 5 minutes, but you should have had your entry from the 1 hour right here. And if you miss this, that's totally fine. In a market maker model, let's zoom out again. We go from internal to external. So here is our drawn liquidity. So once we start breaking lower, 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 what do we have here? Why do we slow down here from this swing low? What is here on the left? What do we have here? Fair value gap and an order block. So once you see this happening, you can drop to the 5 minute again. 1 hour level. This is a 1 hour value gap, 1 hour level, 5 minute buy structure. And what do we see here? We see failure swings, we see equal highs, aggressive sells, aggressive buys. There's no fair value gap in this move. You see this wick stops that. But what I do see is a small fair value gap here. So I would already take my entry right here, or otherwise look for the second fair value gap that would be here. So let's say put it here, target this high for static 1 to 2. You would have get your TP right here. And it's again all based on a daily level. From daily, internal to external, 1 hour market maker models. And even in those 1 hour market maker models, on a 1 hour, you can drop to the 5 minute to refine your entry. But everything happens on the higher time frame. So in this final example, we're just continuing where we left off. We have another daily bullish fair value gap. You wait for price to come back into there, jump to the 1 hour, and here again is where you want to get in. Well, this doesn't look to me like a very clean entry, right? Because we could have taken an entry and it was right here in this 1 hour fair value gap. But again, if I expect price to move away from a daily fair value gap, and also we have a 1 hour order block, I drop to the lower time frame to see, okay, can I find an entry here? And what do we see here? We start with an original consolidation up here. Then we move lower and lower, lower into the daily bullish fair value gap. And there we make that smart money reversal. Aggressive sells, aggressive buys with that first fair value gap. Then we have the series of down close candle that trade into the fair value gap, the bullish order block. Price respects this before trading higher again, creating a new fair value gap. And you see from that point how all the discount arrays are holding. And that's what you want to see. And this happens in the Asian session. If you're trading London session or New York session, you would have missed this trade. That's fine. Then you wake up to this piece of price action right here. You see displacement happening into London session. At the end of the London session, we trade back into this. What was this? It was the 1 hour fair value gap. It was this one. From the 1 hour fair value gap, we start to move away again. And where do we end up? Taking out that buy side liquidity. So step 1 is finding higher time frame trending conditions. If higher time frame, daily, weekly, monthly is bullish, look for bullish arrays, bullish fair value gaps, bullish order blocks, bullish breakers. Mark them out on your chart. Make sure they are marked out, and once price get in there, use time frame alignment to go from higher time frame to lower time frame. Just find your smart money reversal on the lower time frame and trade your lower time frame market maker models towards the clear drawn liquidity. High probability is with the trend. You can also trade from external to internal. By default, that is lower probability because you're trading contra trend. But if you want to do it, that's fine as well. I like to take my trades high probability, so that means from internal to external. You might wonder how to determine daily bias or how to match fair value gaps or order blocks. Good news, I've dedicated videos to this here on this channel. I'll leave a link to them here down in the description. Thanks for watching, and I'll see you in the next one.